Ajay Botke, Head Investment Strategist and Advisory with Prabhudas Liladhar. Ajay, morning. Thank you for joining us. Let me first start with the moot point. And the moot point is, when Barack Obama got re-elected, everyone thought that it will be a risk-on event, and that meant that global liquidity will continue. But if I look at how financial markets have moved in last 24 hours, things have moved the other way around.
Yes, I think the markets sort of are now focusing from now till the beginning of next calendar year on how the fractious Congress is able to resolve the fiscal cliff issue. I think in the month of August we had flagged off that unless I think there is a bipartisan consensus among the Republicans and Democrats who each control one house of the Congress, I think we are looking at roughly around $600 billion of total increases in taxes as well as automatic spending cuts that is expected in the worst scenario to shave off roughly 4% of America's GDP in calendar year 2013. Now when you look at the forecast by IMF is expecting American economy to grow at 2.2% this calendar year and around 2.75% next calendar year. So you're looking at, if nothing, sort of, if worse were to eventuate, worse things were to happen, then I think you're looking at a negative growth in the American GDP. And that has really sent tremors across the global financial markets. That the elections have again thrown a divided mandate, with the Republicans coming back and controlling the lower house, House of Representatives, and the Democrats increasing their tally by 2 seats in the upper house, the Senate. So how things pan out from now will be the key factor that will determine the trajectory of the global financial markets. In addition to that, I think the statement by Mario Draghi that Germany, which was comparatively in a fine fettle as compared to the southern European countries, also is facing some sort of a turbulence. We saw that in the industrial production numbers that were announced yesterday, as against 0.4% of dip in the industrial production that was expected. The numbers plunged by 1.8%, and that also is a real big cause of worry. And let's not forget that we are in a very crucial week insofar as the second largest global economy is concerned. There is a once-in-a-decade transition wherein the entire Politburo of China will be a new Politburo will be taking over, and a new chief of the Communist Party, Xi Jinping, will take over. So there are a lot of global events which will have to be closely watched.
Fair point. So what should Indian investors do? After a 25% run-up this year, it's time to log out, cash out, or Indian investors should use every decline to their advantage and they should keep buying?
Yeah, I think we've had extremely good September and October. We've had a series of announcements on 13th and 14th September from the government, kickstarting some much-needed, albeit politically unpalatable reforms, followed up again by announcements on 4th of October. And we've had very good FI inflows pouring in on the back of those positive announcements. But I think from the current levels, I believe that if the global risk-on trade were to recede, then I think we are up against a large headwind. At the same time, I think what the market will be watching for from the Indian policymakers is the on-ground implementation of the reforms that have been announced, whether there is any rollback of, for instance, the LPG cap. That will be closely watched. And in addition to that, I think the earnings season that has that is the results season that is currently on has really been very patchy and mixed. Because as we had on your own program, I had come in a month back and we had discussed the pre-quarterly numbers, and we had expected that the largest sector, which is the banking sector, will clearly be a story of contrasting halves. When we had said that the public sector banking space will reel under increasing bad debt problems, whereas the private sector guys and the NBFCs will remain comparatively unscathed. And the results that have come in from the banking sector, which contributes 26% of the total index weight, clearly.
Right. Ajay, Do you worry about the course Q2 earnings have taken? Because if I map most of the Nifty 50 companies, revenue is coming under pressure and margins also are experiencing what could be called as a marginal decline.
Yes, I think the revenues we had said in the pre-quarterly would sort of be at around 8 to 9 quarter low, and the results till now have borne it out. Whereas we had said that the margins will be better because of the moderation in the input costs on a YOY basis and the near absence of forex losses, which had impacted the profitability of many companies same quarter last year. So these two reasons essentially have been responsible for the margins coming out to be a shade better than the top line growth. But as I think as we're discussing, I think a whole host of sectors have sort of given results which have been really disappointing. Public sector banking being one of them. If you look at the sectors that have outperformed, cement numbers, I think although the volume growth has been a tad anemic, but the pricing power is so strong in the sector that I think the bottom line growth is extremely strong there. We've also seen some of the numbers from pharmaceutical sector to be extremely good, whereas numbers from metals, real estate, power and construction, with the sole exception of the biggest of them all, L&T, have been quite disappointing till now. So I think the earnings season has been really mixed, more towards on a disappointing side than sort of something which should be of joy or elation.
Ajay, Tata Motors, it currently based on FY13 estimates, Tata Motors is trading at a P multiple of 5 times. Based on FY14 estimates, it is about 4.5 times. Do you think at the current juncture, Tata Motors is a cheap stock to own?
I think we have an accumulate rating on the stock, and I think our analyst believes that if you adjust for the R&D write-off, which sort of is done by the global peers instead of the 20% write-off that Tata Motors does, then I think the stock trades more or less in line with the global measures, and hence I think in the auto sector our preference still lies with Maruti Suzuki. And there I think we are expecting, we had upgraded the stock a couple of months back. The target price went up from around 1300 levels to 1593 levels, and we are still quite positive on Maruti Suzuki. We are still expecting an upside of around 10% from the current levels in Maruti Suzuki, and the positive sort of argument was essentially based on the ramp up in the Manesar plant from 1200 to around 1800 sort of vehicles per day of production, as well as the new Alto and the response that it had evinced from the market. So we continue to remain more positive on Maruti than Tata Motors.
Ajay, of late some real estate stocks have made a comeback. What is your house view? Do you think real estate is a bad business but is available at good price, or real estate stocks are still got a bad business and a bad price?
I think we would still wait for some sort of clarity on how the extent and pace of reduction in interest rates from the central bank to take sort of a stance on interest sensitive sectors like real estate. And I think from the RBI's comment it is very clear that unless they see some real action in terms of curtailing subsidies by the government, they are not going to be goaded into cutting interest rates as aggressively as the government would want them to. So I think the affordability is still a question. Prices in many markets have not yet cracked, and hence I think volumes in quite a few of them, especially in the Mumbai and Delhi markets, have suffered. So I would wait for a cue from the central bank on the trajectory of interest rates going forward before taking a call on real estate.
I just want to get your thoughts on IT before we let you go. And does it seem like that with Obama's re-election and his views on outsourcing, that could spell any danger for the IT sector?
Well, I don't think so. I think the pre-election rhetoric is more or less expected. When you have unemployment rates, upwards of 8%, and sort of the jobless rate being the main point of discourse between the two warring candidates, I think it is but natural for sort of the candidates to spar on the benefits or otherwise of outsourcing. But I think, in my view, I think now that the elections are through, one should see a toning down to a very large extent of that rhetoric, and I think it's business as usual, in my opinion, about the IT sector. So I am not really unduly worried about a shrilling rhetoric again getting louder in the American political discourse going forward till next elections.